All right, the time has come. Frank Rohde, welcome to the show. How does it feel? First of all, where are you coming from today?
I'm coming to you from my basement in San Francisco.
San Francisco. Always love the weather chat. How's the weather out there? It's still
It's
early morning while we're recording this,
it's
right?
actually really beautiful today. It's one of the rare days where it's sunny and warm and the fog hasn't come in yet. So
Oh wow, wow,
really
very
nice.
cool. If you could let the listeners know, Frank, just a little bit about your background, your history, professional history, kind of where that's led you at and where you're at now.
All right. Yeah, thanks. First of all, Brett, thanks for having me. Excited to be here. Yeah, where do I start? I mean, I was born in Germany and I grew up there and lived there until I was 18, 19. Came to the US for college, went to Penn. I did the Wharton undergrad program there. Then moved to the West Coast where I've been ever since. And spent a couple of years in consulting, financial services. I started an insurance company early on, then spent a couple of years at FICO, getting into credit risk underwriting and some of the software that banks use. And that led me to start a company called Nomis Solutions, which I ran for about 15 years as CEO, and eventually sold it 2 years ago. And that company built the pricing engine for a lot of the large mortgage lenders in the US and Canada, Australia, the UK. So I got really deep into mortgage pricing and mortgage math, right? Spent kind of 15 years in the bowels of that. And one of the interesting things that came out of that was really that the mortgage business in the US is very government centric and structured, right? Basically, everyone is selling the kind of conforming products, right? And those are great products for most folks, but one of the things we kept seeing in the data over and over again is that first-time buyers in particular are being left behind, right? And are struggling to get into the market. And if you look at the last couple of years, in particular the last 2 years, that's gotten a lot worse, right? And so I sold Nomis 2 years ago and then started the company that I'm running now called Ownify. And Ownify is really an alternative path for first-time home buyers to get into the market. And what we're doing in a nutshell is we're partnering first-time buyers with investors to create fractional ownership structures around single-family homes, around starter homes, right? And so that's what I'm excited to talk about, and what's core to my mission and potentially interesting to your audience as well. But I think one of the big things we learned, right, looking at mortgage lending and how it helps the first-time buyers, that first-time buyers in the US today are really struggling for a couple of reasons. And one big one is the down payment, right? So you need 10% down payment, and in some markets 20%. If you show up with a low down payment product, like an FHA mortgage or some other low down payment solution, a lot of times sellers won't even consider your offer, right? So you're getting outbid in the market. First-time buyers are struggling with the monthly payment, right? Because mortgage rates are high and home prices continue to go up, so the affordability itself has gotten much, much harder. You have more student debt, right? Despite what the government is trying to do, you've got a ton of student debt out there that is weighing on the budget of first-time buyers. So you have folks who, might have enough income, but they're paying $500 or $1,000 a month in student loans, and that weighs on their ability to afford mortgages. And then, especially for first-time buyers, you now have basically a tax policy where, if you're making $100,000 as a young couple and you're looking to buy a $300,000-$400,000 starter home, you're not itemizing your taxes. You're taking the standard deduction. So this benefit that used to, support homeowners through the mortgage interest tax deduction really doesn't help you anymore, right? And so all of these things have come together. And we could see that in the data where, first-time buyers are just struggling. And you probably hear this anecdotally, right? In your circle of friends and folks you talk to, it's like, well, it's getting tougher and tougher, right? I know it's the case in Charlotte, it's the case in Raleigh, Durham, the Triangle where we launched, right? Nashville, no matter where you look, it's the same story. And so that was really the genesis of starting Ownify, to say, is there a path here where we can structure an on-ramp for first-time buyers that doesn't involve debt? That actually looks at the home as a true investment opportunity without, a mortgage, without debt, and gives the first-time buyer the ability to purchase their home in that fashion, right, as equity.
What are the pros and cons versus, having your own agent as an prospective ONI?
So we do both, right? Some owners come in with their agent, or the agent heard about us. We've had that a lot, where agents call us and say, I've got this customer, maybe they have an FHA mortgage, or they haven't qualified for a mortgage. They want to buy a house, can you help them? So agents bring in customers, or a customer comes in because they've heard about us and they bring their own agent, and that's fine. We then accredit the agent. So there's a section on the Ownify website that is specifically focused on agents and their accreditation process, right? So if you're listening to this, you're a real estate agent and you say, I want to represent Ownify in Charlotte, right? Or some other market, you can do that. And then we also have agents, right, that where someone comes in as a customer and they don't have an agent, we will partner them with, our preferred agent in that particular market.
Nice. And then the depreciation, when you're running just straight line depreciation, bringing it back to the fund then, or are you ever doing like cost segregation? And then what happens on the recapture when the property does sell?
Yeah, so it's straight line depreciation, right? For single family homes, there really isn't enough value in segregation and kind of accelerating depreciation. Most of these homes just don't have a whole lot of complexity to them, right? They're pretty plain vanilla starter homes. So it's straight line depreciation. And yes, when these homes do sell to the ONI, which is the preferred outcome, there is depreciation recapture at the end of that period, right? That comes back to the investor.
Where do you see the lifetime or the life turn of these? Is it, I heard you say that 5-year period, is that kind of where you're angling, leveraging your experience with the first company that you created, knowing that that's the lifetime of what these investments would be?
Yeah, I think that's a little bit of an unknown, right? I think 5 years is the sweet spot if you think about it from a couple of perspectives. One, it allows the ONI to build equity from 2 to 10% without a disproportionately large payment, right? So the monthly payment kind of stays manageable and gets the equity up to 10%. And 10% is really a good minimum to say, with 10% I can get a mortgage, I can use that as a down payment, right? Getting someone to 10% in 3 years is a lot tougher. So 5 years seems to be the sweet spot there. Once you go to 7 years, I think investors look at it and go, that's a really long hold period, right? So we're trying to balance kind of where do we get the ONI far enough and at the same time have an attractive investor value prop. That's the 5-year horizon. Now, the way the program is designed, the golden path, if you will, for the ONI is at the end of 5 years, you have your 10% equity built up. If you want to buy the home from the LLC, i.e. from the fund effectively, with a mortgage, you can do that. Now, you can also say, I want to stay in the home and just keep going with Ownify. I renew for another 5 years, and maybe I'll continue building equity from 10 to 20% or 10 to 15%, right? I don't really need a mortgage. I'm fine with unlevered appreciation, and that's perfectly fine, right? We keep the customer in the home, and we may put it into a new fund, right, to create some cash return back to the original set of investors. Or the customer can also decide, I'm walking away, at the end of 5 years, I want to take my built up equity, and at that point, Ownify will buy it back from the ONI, but we charge a 2% relisting fee. At the end of the day, the goal here for us, for Ownify, is not to run a portfolio of rental homes where you have vacancy and marketing costs and lease up expenses, etc. It is really providing that on-ramp to the first-time buyer, and therefore by design we always have 100% occupancy rate. Right? We don't buy a home until we have an ONI who says, I want that home and I want to live in it, right? And on the day it closes, they start paying rent. That's the perfect scenario.